The broadcast is now starting. All attendees are in listen-only mode.
Good day, everyone, and thank you for joining us today. We're glad that you could be with us. This is Jason Leeswee, and I'm joined by our CEO, Jeremy Fair, and Portfolio Manager, Paul Vandrinsky. We've got a lot to cover today, so I'll jump right into it. I'll be introducing, if you go to the next slide, Jeremy, I'll be introducing a concept we're calling True Tactical, followed by a fund update from Paul, and then a market update from Jeremy. As always, if there's any questions, please feel free to type them into the question box, and we will address them at the end of the presentation. So moving on to the next slide. You know, tactical investing has been around for many decades, and its use among the advisor community really seemed to increase after the challenging decade between 2000 and 2010, where, as we all know, we experienced two severe equity bear markets. Portfolio management essentially evolved from simply developing passive models based on future market assumptions to one based on actively managing those models in real time within the current market cycle. So adapting to the current market cycle really became the focus of many investment advisors over the past 10 years. Of course, this was easier said than done. The challenge of the strategy was really not theoretical, but more practical. It was difficult to implement from an administrative standpoint. As a result, many advisors we are working with today have really begun to rethink tactical investing in order to make it more efficient and effective as a tool for portfolio management. On the next slide, we have the definition here of tactical investing according to Investopedia, an active management portfolio strategy that shifts the percentage of assets held in various categories to take advantage of market price anomalies in strong market sectors. This is obviously a very simple definition that, in our opinion, doesn't explain how diverse this category actually is in terms of its application. On the next slide, this slide illustrates our perspective on this category. We see tactical investing as a wide spectrum where the key differentiator between tactical mandates is what we call its tactical range. Many tactical mandates sit on the far left of this spectrum where its tactical range is anywhere from plus or minus 10 to plus or minus 25% based on its initial asset allocation mix. Some mandates, like alternative funds, for example, might have a range of up to 50% plus or minus. At SIA Wealth, our equity mandates have a tactical range between 0 and 100%. We define this flexibility as true tactical. On the next slide, we're really answering the question of why you need true tactical. Well, in our opinion, market movements can be dramatic, and therefore your portfolio needs to be sufficiently adaptable. In these periods, a mandate with a narrow tactical range will have much less of an impact on your overall portfolio. So if your intention for your tactical component is to have a significant impact on the whole portfolio during times of extreme market movements, then you might want to consider a tactical mandate with the widest tactical range possible. So this really is the essence and application of what we're calling true tactical. On the next slide is really our demonstration of our true tactical strategy in action over the past 5 years using our BMO Tactical Global Equity ETF Fund. During the red periods, we were positioned for safety in 100% bonds. Then we were positioned for growth in the green periods with close to 100% equities. Therefore, the true tactical strategy is intended really as an indispensable lever within your portfolios where its tactical range of 0 to 100 can really make a meaningful impact on your client's total portfolio. Finally, on the last slide for me here, again, in terms of implementation, to reiterate, if you intend to develop a tactical portfolios that sufficiently adapt to the changing market environment, but really struggle with implementing it across your entire business, we would suggest rethinking your tactical strategy by incorporating a true tactical mandate as a way really to automate this process. And we feel a 15 to 20% sleeve can make a sufficient impact. We will be providing a lot more information on this in the coming weeks and months, including videos and presentations you can use to educate your clients. For today, I just wanted to give you a brief introduction to this concept to keep you abreast of what's coming very shortly from SIA Wealth. I'll now turn it over to Paul for his fund update.
Thanks a lot, Jason, and good afternoon or good morning, everyone, for joining us here today. I'm just going to briefly cover the 5 funds that we're sub-advisor for at BMO here. If you go to the next slide, this is a snapshot as of the end of October. I know the end of October feels like a a lifetime ago, really, because of everything that's happened this month. But I think this is a really relevant period to look at. Similar with what Jason mentioned, every one of our 5 funds here can and are used as tactical sleeves within various IPSs. Whether it's a Canadian-only portfolio or a sleeve or it's a balanced portfolio, every one of these can have a place within it. First, I wanted to point out, as I mentioned, the relevant time period really being what I've highlighted here, the 6-month numbers. As of the end of October, it was a full 6 months since the SIACharts equity action call moved into that green favored zone, allowing for very dramatic and tactical shifts within most of these portfolios. It allowed us to buy into the equity markets where we were sitting on the sidelines. And as you can see here, prior to that 6 months, it was really our risk reduction period where we moved to the sidelines. And then since then, over the 6 months into November here, is really a bit of our catch up and return generation. And you can see here by some of the numbers that the sectors we are participating in have been doing fairly well. You can see the Canadian equity up over 6% over the past 6 months. The Focus North American Equity Fund, even a bit better, 9%. At the very bottom there, the Global Equity ETF Fund, that's the sector-based and broad-based ETFs, up 11.85, the clear winner for this period. But these are all benefiting because of the sectors and the exposure we have. Just to touch on a few of the other ones, the bond funds had definitely a tough 2020, especially with the volatility of the US and the Canadian dollar relationship, and that's seen also within the asset allocation fund. But the 2-year number, which isn't actually posted on this slide, is sitting around that 2.8 mark as of the end of October. So it, with all of these other funds, is still a tactical mandate, giving a tactical sleeve to a domestic bond portfolio, for example, but giving yield diversification outside of Canada. For all of the funds, it's really the times where we see those rotational periods that in many times we see the underperformance take place, but usually only for a relatively short period of time while we recover, catch up, and outperform. Really patience is key for this. So over the last 6 months for the equities, we're seeing a lot of strength still on most of these, catching up to that zero line or even our relative benchmarks year to date. But we believe with these portfolios, we're currently sitting where we're seeing strength. If we move ahead a couple of slides, we're just going to focus in on these 2 mandates that have done particularly well over the last 6 months and talk about why and what we own. So first of all, the BMO Tactical Global Equity ETF Fund, as you may be aware, it's comprised of a 25% exposure to individual stocks, and the remaining 75% is split evenly between broad-based and sector-based ETFs. As a snapshot as of the end of October, and also mostly what we went into right at the end of April and the start of May, was dominated with the IT sector, both individual names and ETFs, the healthcare, consumer discretionary, and at the end of October, some materials and industrials. You can see here, similar to what Jason has been talking about today and in the past, we moved out of the markets in mid-March and re-entered them at the very end of April, and have really caught up. So for that advisor or that client, who's looking for participation in the markets with less risk, this slide really is evident in showing that we did just that. We cushioned on about 50% of the downside, but then at the end of March have really caught up to the zero line as well as the benchmark. As far as what happened recently, because as I mentioned, a lot's taken place during this month to speak of. So really, since the election results, we saw some rotation. So as I mentioned, we were heavily weighted into tech. We saw some changes in the portfolio. Last week, we moved out of, just for a few examples, moved out of the home construction ETF that we held for quite a while since we moved back into the equity markets, locking in a gain of around 38%, and moved into the clean energy space. This is sort of sector ETF holding. As far as some of the individual stock names, we moved out of Amazon into General Motors. So this is a shift out of obviously some tech into the automotive sector, but with that move out of Amazon locked in a very strong realized gain. So that was really the only changes we saw on this one. On the next slide, we'll have a peek at the BMO SIA Focused North American Equity Fund, where we saw a little bit more changes recently. But first of all, a very similar chart. You see what happened in March, see what happened after getting back in April, and really giving the investor that lower volatility, higher Sharpe ratio for a mandate that is able to tactically shift depending on our risk viewpoints. So as far as shifts since the end of October, at that time we were sitting at, this is a 15 stock strategy. As a reminder, 80% was US traded and 20% Canadian traded. The shift that took place with some of the names over the last week and a half, 2 weeks, has moved that allocation to about a 60-40. So 60% US traded, 40% Canadian traded. And whether this is because of fundamental differences in performance for Canadian stocks, or also tied to the US-Canadian dollar relationship, there's probably a little bit of both in there. The shifts we saw over the last week, we also saw Amazon move out of the portfolio, but we also saw a few other tech names. PayPal, Amazon, Microsoft were all sold and replaced with Canadian names. But with all of these, we did see realized gains looking pretty strong. PayPal was bought when we moved back in, and it's a 40+% rate of return. Amazon close to 20, Microsoft about 15, and Apple around 45%. So big moves. The one loser was something we purchased within this time period. Agnico Eagle lost about 12%. But these were 5 positions that very quickly changed after the election and speculation on what might be happening. We moved into the Canadian markets, as I mentioned, specifically into Gildan, Magna. We bought shares of Canadian Tire as well as CP Rail. So whether the shift continues more into the Canadian names will remain to be seen going into the rest of probably a very volatile period, the rest of the year into next year. And, you know, the beauty of this process and this mandate, it allows us from a Canadian perspective, Canadian investor perspective, to buy the best risk-adjusted after currency implications for us. So with that, just like to thank you. Jeremy will talk about some of the risk or what we're seeing going forward, and thanks for joining us.
Thanks, Paul, and thanks, Jason, for those introductions. True Tactical is certainly something that we feel very strongly about, and we think will fit well into your portfolios, and you can see from Paul's update there, they can do so. Today, I'm just going to talk a little bit. We've had quite an exciting short period of time here. We've got the coronavirus is now fully into its second wave. The chart that we see here on the right shows the United States, the lighter color there. The one beneath that is the United Kingdom, and then the one beneath that is Canada. So we continue to see an upward trend in the coronavirus infections across the world, and certainly there's some risk with the economy as far as us having further shutdowns or other aggressive measures taken by government to reduce the infection rate going forward. So continues in line with what we saw in our last update in later part of October. We're still seeing tremendous coronavirus infections coming into the world. I think the most important event in between the last update is the U.S. election. We talked at the last update about how close it was going to be. Certainly, according to the Associated Press, Biden has a decisive victory with 290 electoral college votes, with Donald Trump with 232. So it looks like Biden's going to be the winner. There's certainly some court cases happening in some of the contentious states. We'll see how those work out. Donald Trump is certainly trying to do as much as he can to delay or even take over the victory from Joe Biden. But to date, it appears that most of these rulings that he's gone after have not worked out too well. So in this individual states, most of the Supreme Courts in those areas have voted in favor of the election results. leaving Biden with the victory. So the Supreme Court has not been ruled out, but it appears that the market is not voting too heavily that it's going to shift anywhere different from here. Looking at the top level analysis, our SIACharts equity action call, we remain in the green zone. I can tell you that nothing has materially changed on this chart since the last time that we spoke, but underlying, we do continue to see some acceleration for equities, international, US, and Canadian equities, so that's good to see. You know, perhaps we'll see some additional strength show up in the equity action call, but we're green right now. This tells us we want to be at the top weighting of our equity allocations within our mandates, and we recommend that across the board for our clients as well. The SIACharts asset class rankings are second level of analysis. We don't have any changes from the last update on October 28th. International equity remains the #1 asset class. Very, very surprising in the time that I've been doing SIACharts since the late 90s, early 2000s. Generally speaking, when we've seen international equity come to the top after an upset like we had here with the downturn in the early part of 2020, US or Canadian equity will overtake it. But to date, international equity has remained at the top of the asset classes, and we'll get to that in a minute. US equity remains in second position, and Canadian equity in the third position, still lagging behind what we've seen from those two other international and US equities. Cash, currencies again just being short-term bonds and currencies other than US and Canada. Bonds in sixth place, and commodities stubbornly sticking it out in the seventh position, even with some of the activity we had in gold, in crude, have not been enough to bring commodities back up against equities or the other asset classes. The first chart we're going to look at today is the SIACharts Market Equal Weight Index versus the SIA Bond Equal Weight Index. I had this chart up, so I'm going to cover a number of the charts that we spoke of on October 28th. You can see on this one on the top right, the prior resistance. We were sitting on this comparison chart with the upward movement favoring equities over bonds and downward movement favoring bonds over equity. So generally speaking, I don't spend a lot of time on the breakout points with it. I think this one was important. We were right at that resistance level prior to the election earlier this month, and we've seen it move up in advance. So this is more money flows moving into equities, going away from fixed income. We continue to see this trend as fixed income remains under tremendous pressure with the extensively low interest rates, and certainly a lot of the activities that are happening fiscally and monetarily out of most governments around the world. So this is positive for us, positive to our equity action green zone, showing us that equities on a broad basis, on an equal weight basis across international, US, and Canada remain in favor. The chart, looking at it by itself, we had already seen this move slightly above its resistance level. We've added a couple more X's to the chart since our last update, so there's room to move here. We would put a technical price objective around that 91,000 and change level on the chart. We're sitting at 82,000, so there's potentially 10–12% of upside in this chart based on a technical risk-reward basis looking at it. Support is relatively nearby above that 75,000 level. We'll be watching to see if we get continued strength, but again, a very, very bullish chart looking at it in apprehension. So when we look at the second wave of COVID, we see that election results that are certainly, potentially getting into a litigious situation. The markets seem to be shrugging this off and being positive with that, with both of those outcomes, at least in the intermediate term. I shifted away from going to our international equal weight index here and wanted to highlight one of the stronger areas within international. There are a number of areas to mention, but China really stands out when we look at the international, broad international investments that are out there. It ranks extremely high in all of our international reports. We had a recent breakout above that 32.29 level. I'm looking at the BMO China equity, so this is all converted back to Canadian currency. We had that breakout at 32.29. Resistance is nearby here in that 35.65 range, but really on a price objective standpoint, we're looking for a $40 level. So again, very much in line with what we saw with the broader equal weight index. The China chart has extremely strong technical attributes, a pullback from here or nearby that 35 level would not be considered negative in amongst itself. So we'll be watching that very closely, and it is a position that we have in one of our mandates. U.S. equity, again, I'm going to go to the BMO MSCI U.S. High Equity ETF, High Quality ETF ranks, again, very high within the ETF. The U.S. ETF reports at SIA. What's important about this chart, and it correlates extremely well with what we've seen with the S&P 500, is that we have a strong technical breakout. We have a triple top on this chart, one of my favorite technical indicators. On just a chart basis, we see that at 49.79. This gives us room even up into those high 50s levels on this chart. Support is sitting around 45, above 45.10. So again, we see with our equal weight index on equities, with our international China, we look at the U.S. again, we're seeing strong positive charts in those top two asset classes that we need to take advantage of while we're in this green equity action call. Canadian equity, not quite as glamorous as China and U.S. equity at this moment in time. We do see that it is below its highs that we saw earlier this year in February, when we had just before we had the crisis. So Canada continues to lag. It has an SMAX score of 5. So we're watching this closely. Canada has moved up a little bit when we're looking at relative, but again, this has come more at the expense of cash, currencies, bonds, and commodities. Its strength is showing up there rather than versus U.S. equity or international equity. So on a broad basis there, Paul mentioned us taking positions recently that are more Canadian-based. That's us being more of a laser beam into the Canadian marketplace. There are areas of additional strength, but the broad market relatively still is lagging those two others. So if you're going for broad-based products, you want to be looking at U.S. or international, and you're going to have be a better stock picker or ETF picker if you're going to go into the Canadian side. So we'll watch really key resistance on this chart is that 2370. If we get above that, that would help us, and we would like to see that in our green equity action call to confirm that we're seeing more and more strength happening within the equity market. The sector rankings, I wanted to bring this up, and this is going to speak a little bit to some of the rotation that Paul spoke of earlier in this conversation. On the left side, we see our market sector report as of October 27, 2020, presented on the 28th. We see leisure, specialty retail at the top. With computer software, we see automotive manufacturing at the bottom of the green zone. We've seen a shift in a rotation, so there hasn't been a tremendous amount out. On the right side, we will see metals and mining is one that has really suffered since our last update, moving from the 5th position to the 9th position. We see that, and I have a chart on gold to talk about that in a few minutes. But what's benefited the most is that leisure has moved up a little bit, specialty retail has moved up a little bit, but automotive has moved from the 7th position up to the 3rd. So those General Motors, Magnas, those types of investments have done much, much better in what we've seen there. We also see manufacturing moving from the 8th position to the 6th position. So these are just all happening within the green zone. These are all areas that we would have spent time and would have potentially invested in, but it's interesting to see that rotation post-election and then post-conversation about some potential vaccines coming out into the world over the last couple of weeks. So that's good news, and we can see that rotation away from traditionally looking at specifically those software businesses and those high-tech businesses. Now we see rotating back into the broader street, which is good for us. Sorry, I'm going to shift back here. One of the things we got to continue to note here is that we still see areas like banking, we see energy still lagging tremendously, financial services lagging tremendously. So these are areas that I think are important for us to monitor and really highlight some of the difficulties Canada has, being some of its bigger sectors. Gold has been a very, very strong commodity since the crisis began. Really took off and saw tremendous growth and volatility over 2020. Reaching well above $2,000 an ounce on that. But what we've seen since August is that bullish market just start getting drawn down. So ever since August, we saw our highs there at that 2,062 level. we're now down into that $1,867 level, which is key support for gold. This is a short-term chart, so I have gone away from my traditional 2% scale to a 1% scale, but we can really see in this chart that gold's been under pressure. 1848 would be a breakdown and open the door into getting us in the 1700s, but would be a continuous of that. So it's something to watch. We could, I guess, hypothesize that the weakness of gold is really coming on the strength of equity markets, the continued potential growth in the global economy as people move away from potential safe haven and gold. That adds more impetus potentially for equity prices rising. I'm going to bring up high-grade copper again. It hasn't changed a lot since our last update on October 28th. We've added one more X from that $3.15 to that $3.22 level, so it hasn't moved up tremendously. The SMAX has weakened a bit. It was a 9, but it lost all of its, the 2 points that it lost was against equities. We've just seen that surge post-election and post-announcements on potential vaccines coming out. But again, copper is seen as a barometer to global equity. We continue to see strength here. It's moving up, so we're happy to see that as well. So overall, very bullish markets. When you look at those comparison charts across the board and the work that I've been doing, they continue to show strength. We did see that rotation in the sectors. We continue to see Canada lagging, so our focus again will be largely on a broad basis in international and US. We can go down to a micro basis in Canada, and if you're there, you want to be there and really focused in on those stronger areas. But those rotations that we've seen post-election are very important, and our mandates have all been updated to those. Listed here is all of our products that we have BMO with BMO Global Asset Management and the symbols with them. So with that, I think I'll open us up for questions, and I believe Jason Lee-Sui is going to ask those.
Great, thanks, Jeremy, and thanks, Paul. Again, just a reminder, if you won't have any questions, please type them into the question box, and we will take them one at a time here. First question will be for Paul. Paul, could you please go over the shifts in asset allocation for the BMO Tactical Global Asset Allocation Fund over the last 6 months?
Sure. Okay. Yeah. Good question. So the immediate change that took place, well, if we're looking at 6 months, exactly 6 months ago is when that equity action call moved to green. So the big shift was away from that 60% exposure to fixed income to 60% exposure to equities. So as a reminder, that portfolio is always comprised of fixed income, sector ETFs, broad-based ETFs, and individual stocks, and at various times different allocations of them. But that's the composition of it, making it kind of like our balanced mandate. So the similar changes I mentioned happening within the BMO Equity Fund, so that ETF change and the stock change, that also took place in there. And that one stock trade from Amazon to GM took place. And an interesting thing I was going to mention, I forgot to, that, if you look at that fund, the Tactical Asset Allocation Fund, it's actually done a fairly good job over whether it's 1-3 or since inception on an absolute basis. It's really done a good job as far as positioning the various investments and the various allocations on various potential outcomes, during these volatile times. One thing you might not have noticed unless you go into each of them is that each of those separate components really go through periods where they offset one of the other areas not doing so well. Just as an example, in 2017 and 2018, it was the individual stocks there that floated that boat. They did so well, they offset any weakness on whether it was the bonds or the other ETFs. In 2019, it was the bond or the fixed income component in the portfolio that was the clear winner. Like into mid last year, the bond component was up almost 10% halfway through the year. And then this year, as I mentioned on the slide showing the BMO Global Equity Fund, it was those components, specifically the ETFs, that have done so well this year. So within the fund, we see that rotation that naturally happens. We also have the individual holdings, which is within each of those components, but it's a real it's a real organic shift within the portfolio. Hope that answers the question. Thanks.
Great, thanks, Paul. Another question we have, and this one I'll pose to Jeremy, is does the skew to the right side of the sector scopes raise a reason for concern for equity markets in general?
Very, very good question. In the intermediate and longer term, no. We would look at that movement with the sector scopes showing us that on a short-term basis, we're getting overbought. We've been there for a while now, and we seem to continue to see an influx of money flows away from currencies, commodities, bonds, and cash, moving into equities. So we can stay overbought here for quite some time. So I don't think we want to make any judgment calls on whether we're going to see a rotation over or not. To my comments that I had earlier on, for example, the equity equal weight index or China, a pullback from here would not, a 3.0 pullback, so that 4 or 5% type of pullback would not be seen at least by its own activity as a negative. So we could see that happen. And would not be shocked if that happened or worried about that on the intermediate trend. Those intermediate trends are in place, and we've seen a number of material breakouts technically on, for example, the S&P 500, that U.S. equity, some of the comparison charts I've looked at, I'm not displaying today, have all improved dramatically over the last week or so. So that's important to mention as well.
Great. Next question, Jeremy, as well. What do you think Trump's announcement of excluding many Chinese stocks from purchase will have on the ETF market?
Yeah, that's another great question. I'm just going to pop back up to China here. We have seen a little bit of weakness because of that. So if I take a relative strength chart of China versus U.S. equity, for example, we can see that we've now moved to a column of O. So there appears to be some short-term weakness. We can't interpret too much from it just yet. This is, all in the context of both of them being in a bull market. So to date, I wouldn't say that it's extremely material on a short-term basis. If you're short-term trading, I think it would be, but for our purposes, it would not be at this time. So it's something we're going to clearly monitor and watch closely to see if that escalates. But at this moment in time, it does not appear to be influencing too much. So we are moving a bit into that traditional lame duck president type of situation. So we'll see how this plays out, and that's something we'll watch going forward.
Great. Paul, this one will be for you. Could you please explain the challenges of the bond fund this year, what the sort of causes were of it, and any changes that you see that you'd potentially need to make to that?
Sure. As far as the bond fund, as I mentioned, it has been a tough 2020. 2019 was so favorable to the holdings we had because the the portfolio mostly held corporate bonds on both sides of the border, which were rockets last year and did very well. And they did very well really into the end of February. What happened there was twofold within the bond fund was the corporate bonds sliding very quickly and dramatically like most of the equity markets. But the other thing too was the volatility between the US and Canadian dollar. Because we shift weightings on both sides of the border, we were a little bit slow in two aspects of the currency move. And what's hurt us here recently was the steady decline of the US dollar. We've seen this in the past before, and like I mentioned, it's usually during those rotational periods where we see some underperformance because of the fixed income, how they move, generally speaking, on an absolute basis. It takes a little bit longer to catch up, but those were the main drivers to what we've seen this year, was really the US dollar versus Canada. As far as changes, here at SIA Wealth, we're always in the research and development mode. We're always looking to tweak and test a lot of different things outside of the bond universe, everything, and this is more of a currency play. So we are looking to test indicators to help us out more with the currency, and we have been making some shifts. Anything formal. Other than that, we'll make more formal announcements, but we are always working on the R&D side of things.
Great, thanks, Paul. And the last question that I see here is, would you replace hedge funds with your true tactical strategy? I'll take that one. That's actually a good question. We're actually seeing advisors reconsider their traditional hedge fund allocation. Obviously, they're really used mostly to lower correlations in times of market stress relative to the whole portfolio. But obviously, they come with some challenges, right? So, for example, lack of liquidity and credit investor rule, higher costs, and in many cases, higher risk ratings. So a true tactical strategy could be a more efficient replacement for many traditional hedge funds, in our opinion. And with that, that's the end of all the questions. So thanks, everyone, again, for your time today. Really appreciate all the support you've given us on these calls. We'll certainly reach out to you with the replay and the PowerPoint. Again, if you have any further questions, don't hesitate to let us know. We'll be back again mid-December with another monthly update. Until then, take care. Bye-bye.
Thanks, everyone.